Welcome to the Deep Dive. Today, we're really digging into a fascinating story. It's about geopolitical pressures clashing head-on with some big structural changes at Hyster-Yale, that's ticker HY. We're looking at their Q2 2025 earnings call, the one they held back on August 6th.
Yeah, and this one is crucial because, this quarter was just pure volatility. You could hear it in management's voice. The whole conversation was dominated by these external things, especially tariffs, escalating geopolitical tariffs and how they're just, ripping through their costs.
Right. So our mission here is to unpack these really mixed signals. You've got a revenue beat, but then this just shocking collapse on the bottom line. We want to figure out what management's doing structurally, their response, and what it means for the company long term, even with all this short-term pain.
Exactly. So let's start with those headlines, the numbers that really show that split.
Okay, yeah, the divergence was pretty stark. Top line, revenues, well, they actually looked okay at first glance. $956.6 million. That managed to beat the consensus estimates, which were sitting around, $937 to $940 million?
Right, a beat. But, and this is a big but, pull back the lens a little, that's still an 18% decline compared to last year.
An 18% drop, yeah. Not exactly stellar growth.
And, that small win on the top line, it just got completely wiped out by the profitability numbers. GAAP earnings per share, it didn't just fall, it swung violently into the red. A loss of negative 79 cents per share.
Wow. Compared to what last year?
Compared to a profit of $3.58 the year before, you just don't see swings like that unless something massive is happening with costs.
The huge turnaround in the wrong direction. And the adjusted number.
Even taking out one-time items, it was still a loss, negative 14 cents per share, completely missed what the street was expecting. They were modeling, anything from maybe a penny profit up to 60 cents, so a big miss.
So the message from the market was pretty clear then?
Oh, absolutely. They sold almost as much stuff as expected, volume-wise, roughly, but they made basically no money doing it.
And the profits.
Right.
Gross profit itself.
Took a nosedive, down 38% year over year, landing at $146.8 million, and the adjusted operating profit, barely there, just $7.2 million.
Okay, so little wonder the market reacted how it did.
Instantaneous and definitive. The stock dropped, was it 12.7% at the close that day? Investors just weren't looking at revenue. They saw the margin compression, the efficiency collapse, and they ran.
Okay, so we see the damage. Let's do the forensics now. Where did that 79-cent loss really come from? Management was actually pretty upfront about quantifying the shock.
They were, unusually so. They pointed the finger squarely at tariffs, said that the extra costs from tariffs, materials, and freight combined cost the lift truck segment about $10 million in Q2 alone.
$10 million. Just straight out of margin.
Straight to cost of goods sold, just decimates it.
And it wasn't just tariffs causing the profit drop, right? There was volume, efficiency.
It was like a triple whammy. First, lower volumes overall. Second, those specific tariff costs we just mentioned. And third, something called reduced manufacturing overhead absorption.
Okay, hang on. Reduced overhead absorption. That sounds a bit technical. Can you break that down for us? What does that mean for a company like Hyster-Yale?
Sure. Think of it like factory efficiency. You have fixed costs, factory rent, salaries, machine depreciation, stuff like that. When your production volume drops really fast, faster than you can cut those fixed costs, your efficiency tanks. Lower absorption means each truck they did manage to build and ship had to carry a bigger slice of those fixed costs. It's a classic sign of a rapid slowdown.
Got it. So inefficiency on top of tariffs and lower volume. And then there was this mix shift thing too.
Right, another layer. Sales tilted more towards their Class 3 products. These are generally lower revenue, lower margin trucks.
Yeah.
So that just added to the pressure on overall profitability.
More pressure. Any bright spots in the mix?
Well, they did mention a sequential improvement. Quarter over quarter, they saw a bit more sales shifting back towards the higher value Class 4 and 5 trucks, the internal combustion engine ones. So maybe a tiny glimmer of hope that the mix might start to help a little later in the year.
Okay. Before we dive into demand and what's coming next, there was one piece of financial news that seemed positive amidst all this chaos.
The credit facility. That was important.
They renewed their $300 million revolving credit line, right?
They did. And not only renewed it, they extended the maturity out to June 2030. And interestingly, they actually negotiated lower borrowing margins.
Lower margins.
Yeah.
While reporting these kinds of numbers.
Exactly. It's a really critical signal. It shows that their lenders, the banks, still have confidence in the company's long-term health and viability, even if the current operations are, really struggling.
That's a great point. Shows the balance sheet is holding up even while the P&L is getting hammered.
Precisely. But let's shift gears now to demand, because this is where that volatility really hit hard and, frankly, spooked investors.
Okay, the bookings number. A 44% sequential drop in lift truck bookings, quarter over quarter. That sounds less like a slowdown and more like hitting a wall.
It was a cliff edge, yeah. Bookings collapsed to just $330 million.
How did management explain that kind of plunge?
Mostly blamed it on, and this was their phrase, heightened tariff-related uncertainty. They argued that customers facing economic jitters and just total unpredictability about future costs, thanks to tariffs, simply slammed the brakes on capital spending, just deferred decisions.
So the whole capital goods sector freezing up because nobody knows what things will cost next month.
Pretty much, that's the picture they painted.
Okay, but even with that collapse in new orders, the existing order backlog is still pretty big historically, right? $1.65 billion.
Still elevated, yes, compared to history. But even that started to shrink. It fell 14% in the quarter because shipments, trucks actually going out the door were finally higher than the new orders coming in.
Right. And this leads us to what you called the core strategic dilemma of the quarter, this pricing lag thing.
This is, I think, the most fascinating and probably painful part of the whole story for them this quarter. Management made a very deliberate, conscious choice. They decided not to go back and raise prices on orders already in their backlog, even when these new tariffs suddenly jacked up their costs.
So they honored the old price, even though their own costs went up. Why? Was it about dealer trust?
Exactly that. They prioritized the long-term relationship, the trust with their dealers, over trying to claw back those immediate costs. Huge move for dealer loyalty, presumably, but the consequence? A temporary lag in cost recovery efforts, as they put it.
Meaning they were shipping trucks that cost them way more to build because of tariffs.
But selling them at the old lower price, potentially even selling them at a loss on a unit basis for a while there. It created this massive mismatch in timing. All the pain hits now, the potential benefit from new, higher prices comes later.
A calculated gamble then. Sacrificing Q2 margin for future goodwill. Okay, so given that pain, what are they actually doing structurally to fix things, to get costs under control while they wait for this backlog situation to sort itself out?
Two main fronts here, pricing strategy and operational efficiency.
Okay, pricing first.
They've moved to a much nimbler system. Monthly price adjustments now, trying to track actual material costs much more closely as tariffs bounce around. The idea is to stop getting caught flat-footed like they did in Q2.
Makes sense. And the operational side. This sounds like more than just tweaking things.
Oh, yeah, definitely. This points to a really deep commitment to lowering their break-even point structurally for the long haul. First, there's the Nuvera business, their hydrogen fuel cell unit. They announced a strategic realignment there specifically to cut costs.
How much savings?
They're expecting annualized run rate savings of somewhere between $15 million and $20 million, kicking in during the second half of this year, 2025.
15 to 20 million. Okay, that's significant. But there was an even bigger number tied to manufacturing, wasn't there?
That's the one. The really transformative number, I think, for the long-term view. Their investing now spent $1.4 million year to date on streamlining manufacturing processes. And this is the figure that gets lost when everyone's just looking at the big EPS loss number for Q2.
What's the target saving?
Once these manufacturing programs are fully implemented, which they expect by 2027, the total annualized savings are projected to be between $30 million and $40 million.
$30 to $40 million a year.
Yeah. And put that in context. Their adjusted operating profit for this entire quarter we're talking about was just $7.2 million. $40 million in annual savings is, well, it's potentially several times their current underlying profit run rate before those savings even hit fully. It's a radical cost structure change.
Okay, that really does reframe the current pain significantly. Let's look ahead then. Management sounded super cautious, blaming volatility, no specific numbers for guidance. Does that signal they're really scared, or is it genuinely just impossible to forecast with tariffs?
I think it's genuinely the latter. They just can't model the tariff impact reliably. That's what caused the whole pricing lag issue to begin with. So yeah, they stuck to a cautious outlook for the second half of 2025. No hard numbers. They did say full year 2025 operating profit would be down significantly and actually come in below what they previously guided, which just underscores how badly Q2 hurt their plan.
And strategically, how are they responding to these tariff-driven supply chain nightmares?
The big buzzword is regionalization. Focus on making stuff and selling it in the same region. They're pushing modular vehicle designs too, so the same basic truck can be built in different factories around the world more easily. The whole goal is agility. cut reliance on crossing borders, especially from high tariff places like China and India, where getting specific components like complex castings is apparently a real bottleneck right now.
Makes sense. Now, the stock price has obviously taken a beating through all this. Trailing return is something like negative 40%, right? While the broader industrial sector, like the XLI ETF, is actually up.
Yeah, roughly negative 40.7% over the last year for HY versus the XLI gaining around 17.2%. A massive underperformance.
Why has Hyster-Yale been hit so much harder than the average industrial company?
It really comes down to their specific exposure. The XLI is broad, lots of different industries. HY is deep in heavy manufacturing, relies heavily on global supply chains for things like those specialized castings, stuff that has to cross borders, often borders with suddenly high tariffs. They're just right in the crosshairs of this particular trade friction.
Are there traditional competitors feeling the same heat? Or is something else going on? Management mentioned Chinese competitors.
They did call them out specifically as a disruptive factor. It seems like the traditional players, the established Western or Japanese brands, are being pretty disciplined, cutting production, holding prices where they can. But management pointed out that China's economy is weak, and their government is apparently stimulating exports pretty heavily.
So flooding the market with cheaper trucks.
That's the implication. An influx of lower cost, maybe government subsidized trucks hitting the global market. It shifts demand towards those value options, which puts more pressure on HY's margins, even separate from tariffs. It basically forces them to make those structural cost cuts just to stay in the game.
Okay, one last detail before we get to the trade idea. There was a little potential bright spot tucked away in tax news.
Ah, yes, the R&D expensing. A potential, maybe small but helpful, tailwind. New tax legislation apparently kicked in, July 4th actually, that lets companies immediately expense R&D costs. They're still figuring out the exact impact, but they said they expect it to mean lower tax expenses and less cash going out for taxes in the second half of 2025. Unquantified, but positive.
All right. Now for our favorite segment. This is not financial advice, but we always try to synthesize these calls into one, let's say, wild yet plausible narrative and potential trade idea. We've laid out how the company seems to be making itself fundamentally healthier long term, while the stock price is just reflecting all this immediate temporary pain. How do you translate that mismatch?
Okay, so the core narrative is all about that timing difference. The stock market right now is laser focused on the Q2 EPS miss, the tariff shock, the booking slump, all the cyclical short-term bad news. It's blinding investors, arguably, to the massive structural cost savings being built in that $30 to $40 million annual target, and blinding them to the fact that they secured liquidity out to 2030. So the stock is pricing in the cyclical bottom, maybe, but completely ignoring the planned structural recovery.
Right. The market sees the illness, not the cure being developed. So what's the actionable trade idea that bets on that cure working?
The idea would be something like a long-dated, deep-in-the-money call option. Thinking maybe an expiration out in 2027, maybe even 2028.
A long-term bet. Why options and why deep in the money?
It's a leveraged bet on the timing. The thesis is tariff uncertainty eventually stabilizes management, thinks it will. That stabilization coincides with those $30, $40 million operational savings really hitting the bottom line. And around the same time, you likely get the natural cyclical recovery in capital goods demand anyway. Combined tariff stability, massive structural cost cuts hitting earnings, and a cyclical demand upturn. You could see a huge acceleration in earnings and valuation recovery, far more than the market expects now. The deep in the money call gives you exposure to that upside with a defined risk, betting on that convergence happening before expiration.
A fascinating thesis, betting that structural improvements will eventually overpower the current cyclical and geopolitical storm. Okay, so to wrap it all up, Hyster-Yale is clearly in what they called an extraordinary transition period. Huge short-term pressures, tariffs, demand collapsing are masking some really disciplined, serious work on operations. Work aimed squarely at lowering costs and boosting long-term profitability, fundamentally changing their break-even point.
Exactly. Which leaves us with a final thought, a question for you, the listener, to chew on. Management made that tough call, prioritize dealer trust, don't raise prices retroactively on the backlog, even though it crushed Q2 margins. That built goodwill, sure, but created that huge cost lag. Now they're building this potentially much lower future cost base. The question is, how fast can they get demand stable again and start really benefiting from that new structure, moving towards their long-term 7% operating profit target before that big lower price backlog they still have to ship becomes too much of a drag in 2026? Crossing that bridge is critical.